The bond that broke the empire, how the treasury market became the tell there is a moment in every empire's history when the debt stops being a tool of power and becomes a symptom of its absence. Most people miss that moment, not because it's hidden, but because it arrives disguised as something routine. A bond auction, a yield adjustment, a quiet shift in who is willing to lend and on what terms. The British Empire missed it in 1947. The question now is whether we are watching the same moment in slow motion unfold again. Part 1. The surface. The United States Treasury market is the largest, most liquid financial market in the world. This is not a claim, it is a mathematical fact. Over $25 trillion in outstanding debt, hundreds of billions in daily trading volume, held by governments, central banks, pension funds, and sovereign wealth funds across every continent. For decades, this market was described using one word: safe. Not profitable, not exciting, safe. When uncertainty rose anywhere in the world, when currencies collapsed, when stock markets fell, when geopolitical crises erupted, capital moved in one direction, into U.S. treasuries, into the dollar, into the assumption that America would always pay, and that the paper it issued would always hold its value. This assumption was not just financial, it was structural. It was the foundation on which the entire post-war global order was built. And now, for the first time in decades, that assumption is being tested. Not dramatically, not all at once, but in the way that structural failures always begin, with small, almost invisible signs of stress, yields rising at the long end of the curve, foreign central banks quietly reducing their treasury holdings, auction demand softening at the margins, bid-to-cover ratios telling a story that headlines rarely translate. Each data point in isolation is explainable. Together they form a pattern, and history has seen this pattern before. Part 2. The parallel. In the early 20th century, the British pound sterling was what the US dollar is today, the reserve currency of the world, the unit in which global trade was settled, the instrument through which British power was projected, not through armies alone, but through capital, through lending, through the assumption that British debt was the safest asset on earth. The British Empire at its peak did not merely control territory, it controlled the financial infrastructure of the world. London was the clearinghouse of global commerce. British banks financed railways in Argentina, cotton markets in Egypt, rubber plantations in Malaya. The pound moved through the veins of the global economy the way blood moves through a body, invisibly, constantly, sustaining everything it touched. And the debt that backed this system, British government bonds known as consols, were considered the benchmark of safety. Safe as the Bank of England, that was the phrase. Then came the wars. The First World War cost Britain approximately £11 billion, equivalent to roughly 70% of GDP. The Second World War nearly doubled that burden. To finance both conflicts, Britain did what empires under pressure always do. It borrowed from its colonies, from its allies, and most critically, from the United States. By 1945, Britain owed the United States approximately $4.33 billion in what became known as the Anglo-American Loan Agreement. The terms were presented as generous, the implications were permanent, because embedded in that loan, in its conditions, its interest requirements, its demand that sterling become convertible, was a quiet transfer of power, not military power, financial power, the kind that matters more. When sterling convertibility was briefly restored in 1947, capital fled Britain within weeks. The pound collapsed. Convertibility was suspended. And in that suspension, in that moment of institutional retreat, the world learned something it would not forget for a generation. Britain could no longer defend its currency, and a currency that cannot be defended is not a reserve currency. It is a memory of one. The pound did not disappear. It did not collapse overnight. It contracted, slowly, systematically, until the dollar filled the space it had once occupied. This is how reserve currency transitions happen, not with a single event, with an accumulation of moments, each one manageable, each one explainable, until the weight becomes too much to carry silently. Part 3. The fracture. The United States is not Britain in 1947. This point is important to acknowledge because the differences are real, and because serious analysis requires precision. America controls the world's primary reserve currency. It issues debt in its own currency, which means it cannot technically default in the way smaller nations can. Its economy remains the largest in the world by nominal GDP. Its capital markets are unmatched in depth and sophistication. These are structural advantages. They are not permanent ones, because the United States now carries a debt load that would have been unthinkable 2 decades ago. Federal debt has crossed $34 trillion. The Congressional Budget Office projects that within 10 years, interest payments alone will consume more of the federal budget than defense spending. Read that again. Not total debt service. Interest payments alone. This is not a projection designed to alarm. It is arithmetic, and arithmetic does not negotiate. What makes this moment structurally different from previous debt cycles is not the size of the number. Large numbers in isolation tell us little. What matters is the combination of factors converging simultaneously, and what that combination reveals about the system's capacity to absorb further pressure. Part 4. The signal in the auction. In April of 2025, something happened in the Treasury market that most financial reporting described as volatility. Volatility is a technical term. It is also sometimes a way of describing something more significant without fully naming it. U.S. Treasury yields, particularly at the 10-year and 30-year end of the curve, moved sharply higher during a period when, by historical pattern, they should have moved lower. Equities were falling. Geopolitical uncertainty was rising. The traditional logic of the flight to safety trade, sell risk, buy treasuries, was not operating as expected. Instead, yields rose, meaning prices fell, meaning someone, or many someones, was selling U.S. government debt into a market that was already under stress. The explanations offered were varied. Hedge fund deleveraging, basis trade unwinds, foreign central bank liquidation. Each explanation is technically plausible. Each may be partially correct. But the explanations miss the deeper question. Why was the Treasury market, the supposed bedrock of the global financial system, moving in a way that suggested its safe haven status was not automatic? Because for most of the post-war era, that status was not merely assumed by investors. It was structurally enforced by the architecture of the global system itself. Dollars were needed for trade. Treasuries were needed for reserves. The demand was not purely voluntary. It was embedded in how the system worked. That architecture is changing, slowly, incrementally, with each bilateral trade agreement settled outside the dollar, with each central bank that adds gold rather than treasuries to its reserve portfolio, with each country that looks at the trajectory of American fiscal policy and quietly recalculates how much dollar-denominated risk it is willing to hold. This is not a coordinated campaign. It does not require conspiracy. It only requires that enough institutions independently reach the same conclusion, that the risk-reward of holding U.S. Treasuries is no longer as unambiguous as it once appeared. When that calculation shifts at the margins, when the incremental buyer becomes less reliable, the burden falls more heavily on those who remain. And a market that is financing itself is a market that is one confidence event away from something more serious. Part 5. What follows the confidence? Britain's financial decline did not produce a British economic catastrophe overnight. The pound weakened, gradually, over years and decades. British living standards did not collapse in 1947 or 1956 or 1967, the year of the next major devaluation. Life continued. The economy adjusted. People adapted. But Britain's capacity to project power, to set terms, to shape outcomes, to be taken seriously as the architect of global order, eroded with each currency crisis. Each devaluation was a negotiation Britain lost before it began. Each request for financial support came with conditions attached by those who held the leverage. The empire did not end with defeat. It ended with a balance sheet. The question for the United States is not whether it will collapse. That framing is both imprecise and unhelpful. The question is more specific and more uncomfortable. At what point does the cost of maintaining the Treasury market's safe haven status exceed the system's capacity to absorb that cost? At what point do the holders of U.S. debt, foreign governments, central banks, institutional investors, begin pricing in a risk premium that has historically been absent? At what point does the dollar's reserve status transition from structural certainty to something that must be actively maintained, defended, at increasing cost? These are not rhetorical questions. They are the questions that British policymakers were forced to confront between 1945 and 1976, when Britain finally required an IMF bailout and submitted formally to the conditions that come with financial dependence. The British Treasury in those years did not lack intelligence or expertise. It was staffed by capable economists and administrators. What it lacked was the structural position to translate expertise into leverage. When you are the borrower, when the world no longer needs your currency more than you need its confidence, expertise becomes advice that others choose whether to accept. Part 6. The pattern. Empires are not defeated by their enemies alone. They are overwhelmed by their commitments. Rome did not fall to the barbarians because they were stronger. Rome fell because the cost of defending the frontier exceeded what the tax base could sustain. And the currency debastements used to bridge that gap destroyed the confidence that had made Rome Rome. Britain did not lose its empire because it lacked the will. It lost it because the financial cost of 2 world wars exhausted the surplus that empire required, and the dollar filled the vacuum that sterling could no longer hold. The United States is not Rome. It is not Britain. Every historical parallel has limits, and serious analysis must acknowledge those limits. But the mechanism, the structural mechanism, is the same across the centuries that separate them. When a system's costs outpace its productive capacity, when debt service crowds out investment, when the safe asset is no longer obviously safe, that is when the pattern activates. Not with a declaration, not with a crisis meeting, not with a date that historians can point to and say, here is where it began, with an auction that draws slightly less demand than expected, with a yield that moves in the wrong direction at the wrong time, with a central bank that adds gold instead of bonds, with a bilateral agreement settled in a currency that is not the dollar. Each signal alone is manageable. Together, they describe a system approaching the limit of what confidence alone can sustain. Closing. There is a moment in every empire's financial history when the debt stops being a demonstration of power and becomes a measure of dependency. Britain reached that moment at the negotiating table in Washington in 1945, signing a loan agreement that preserved the appearance of a great power while quietly transferring its financial sovereignty across the Atlantic. But the distance between where it stands and where Britain stood in 1944, before the loan, before the IMF, before the quiet acknowledgement that sterling could no longer hold the world, that distance is not as large as confidence suggests. History does not repeat. But the mechanics of confidence, how it accumulates, how it erodes, how quickly a safe asset becomes a questioned one, are consistent across centuries. The bond market is not merely a financial instrument, it is a referendum, held continuously, invisibly, by every institution that holds U.S. debt, on whether American financial dominance remains credible. For now, the vote holds, but the margin is narrowing. And in the history of such referendums, the margin never narrows gradually, then stabilizes, It narrows gradually, then all at once.